Gold climbing higher today, now approaching $2,500 an ounce. The precious metal has risen over 20% so far this year, and our next guest says it may have even more room to run. Joining me now is Mike McGlone, senior macro strategist at Bloomberg Intelligence. Mike, thanks for being here. I want to start on the catalyst for this run-up that we've seen in gold, and there has been quite a few, but what's really fueling this rally in your view, and is now still the right time to buy?
Well, I think gold is just a matter of time it gets to $3,000 an ounce. It looks like it's put in a pretty good support area around 2,000. It's probably raising that up around 2,200. And a little bit contrary to your previous guest, to me, gold is indicating there's bigger problems with the macroeconomy. On a year-to-date, 1 year, 2 year, and 3 year basis, the rock is beating stocks. It's beating the S&P 500 total return. It means something. But I think the key thing to remember about gold is to mention why it's going up. You have to start with the unlimited friendship that started with President Xi and President Putin in 2022, and then Russia's invasion of Ukraine. That shifted the world order, tilted towards gold. The deepest pockets on the planet have been buying gold, i.e. central banks. And one thing that's been significant has been big outflows in gold. ETFs have been selling, but just the last few months, they started turning upwards. So I think what people are realizing is this risk-off asset is probably likely to continue, particularly if we tilt towards the U.S. recession and U.S. bond yields. Looks like they're peaking from pretty high levels, just looking at things like 200-day moving averages.
Mm-hmm. So you said you see gold quickly approaching $3,000 an ounce. When do you think that will happen? And is that the ceiling for you? Where do you see gold pricing, the ceiling topping out?
So I'll be honest, I didn't say quickly, but I think it's just a matter of time it gets there. I don't know how long. It's one of those lessons I learned as an ex-trader, ex-investors. Don't put time and price together. I'm going to continue to go higher. I think the key catalyst for gold to potentially go higher is when we have some further back and fill in the stock market. The mantra I've been saying for almost 2 years now is why buy gold with US Treasury T-bills at 5% and the stock market on a tear. Well, that seems to be shifting. And one key indicator is volatility. Look at the VIX volatility index, the 200-day moving average. It's bottoming right now in the process of bottoming from the lowest level since 2018. So stock market volatility is mean reverting higher. Stock market prices are probably reverting downward a little bit for this elusive recession that hasn't happened yet. And gold has been the main outlier. So I'll end with this. The Bloomberg Commodity Index on a 1 year basis is actually down. And you mentioned gold's up almost 30%. So that is a pretty severe global deflationary trajectory. Industrial metals were up about 24% this year. Now they're down. So I don't see what ends it. I think it risks that it's going to accelerate.
Looking at some other commodities there, you see oil falling further this year. Crude is up just about 8% since the start of the year. So what's your thesis behind the drop there and where you see oil prices going over the long term?
Oil is succumbing to the high price cure that affected natural gas. It went to 10 and back down to 1.5. Affected corn that went up to 8 and back down to 4. Soybeans that are dropped below 10 today. It's just a matter of time. I think it gets near or below its cost of production in the largest producer in the world, which is the U.S., around $55 a barrel. What's holding it up right now is obviously geopolitical issues. OPEC has been a major pulling off a major amount of supply, but that OPEC excess spare capacity is roughly matching the excess of supply and demand out of the U.S. and Canada. So OPEC, to me, crude oil is a bear market, but one issue is the hedge funds are on top of it. Managed money net positions have sold out completely in Brent and petroleum, the lowest managed amount of net longs in petroleum positions in our database since 2011, which is somewhat of a buoyancy factor for crude oil. But to me, it's a matter of time it gets down to that low price cure, particularly if the U.S. stock market rolls over with higher prices and lower volatility. You need some kind of supply shock. And if we do get that, it spikes crude and accelerates a global recession, which is what we're seeing for most other commodities.
A lot to watch there in the commodity space. Mike McGlone, senior macro strategist at Bloomberg Intelligence. Thanks for being here.